So this is one of those stocks that I periodically sell puts on, Venture Global, and I did a video on it before and people asked me questions on it. So I sell puts on it, and I was assigned some puts on Friday, I believe, at $8. So like a few of them at 8 and a few of them at 9. And as you can see, on Friday it finished 7 something. But this morning it's up over 8. So if I wanted to sell those puts that I was assigned the shares at $8 as of today, I'd be up about 5.69%. And, I did have to hold it over the weekend, but that's not bad for 2 days' work. And this morning, actually, it was a lot higher. This morning, it was up I want to say 10%, 12% or something. And I guess I should have sold in the morning, but, I think at this price, it's still underpriced. So I did listen to the conference call because I like to buy or sell based on information, not noise, and the stock price is just noise. And I did like what I hear. So the big thing holding this back is the threat of lawsuits. They made an incredible amount of money because demand for natural gas, liquefied natural gas, is going up, and they are selling a lot of shipments. And that is predicted to go up and up because of demand from AI and things like that. So if the demand for natural gas doubles, that's a pretty reasonable assumption. And, if the amount of people providing these natural gas facilities doubles the amount of natural gas that they can export, but demand triples, they'll still do great. And what I did like is there is this threat, an overhang of lawsuits. And I've seen different numbers bandied about, anywhere from 1 billion if they lose the lawsuits to 4 or 5 billion if they lose the lawsuits. But they have gone to arbitration, and in arbitration, they won one, they settled one, and then they lost one. So on the conference call, somebody asked them, on the remaining lawsuits, which are not as big as the ones that the major ones with Shell and I can't remember who the other one was, probably BP. They said, well, what's your maximum exposure? So this isn't legal advice, but as a lawyer, I will say that in commercial contracts, you don't get punitive damages like you would in a personal injury suit. So in a personal injury suit, if the doctor did something outrageous, the jury can come back with, punitive damages and things like that. But in a contract case, there aren't punitive damages. It's just economic. And as I said, 3 cases are over. So they won one, they settled one, and they lost one. And if the remaining cases are all lost, their maximum exposure would be less than 800 million. I can't remember the exact number. It was either 716 or 760. But their calculation is that based on the contracts, if they lost all of the upcoming cases, their maximum exposure would be less than 800 million, which is down a lot from the original people who were bearish on this, who said that they could be on the hook for anywhere from $3 to $6 billion. So I think it's considerably de-risked from here, especially if they have the approvals to expand their facilities and new facilities. And eventually this could be twice the capacity of Cheniere, which was the first LNG facility in the US. And they have a more efficient process because they fab offsite, and it's sort of this modular thing. And they can start operating and selling spot shipments before it's fully finished. And they have locked-in financing and locked-in long-term supplies. So I like the setup here. I do use this as a trading sardine because I'm trying to focus on long-term compounders like Google and Amazon, and avoid these what my friend calls commodity shitcos. But when they trade so cheap like this, I don't mind buying them and selling them. So I did have I think like $5,000 worth of this, and I sold it at 14 something, either 1450 or 1480. and I made a nice return on that. And now that I've gotten the put assigned at $8 or $9, I don't mind sitting on this till the price comes back. This does trade incredibly volatilely. And if you can see, the 52-week range has gone from 24 to 675, and it's a fairly new company. So here it is. It debuted at 24, went down to 15 here, up to 11, $9, $7, up here $19, down here 15, 16, 12, 15, and now we're here. So it's very volatile. And this only went public in February of last year. So in less than a year, it's been all over the place. And for a company that you don't want to own long term, but is very volatile like this, if you can figure out a reasonable value, and when it trades in that range of reasonableness, you can just ignore it. But if it trades really cheap like this, I don't mind buying it. And if it gets really high, I don't mind selling it. And in the middle, you just sort of sit on your hands and wait. And, I'm not telling you to buy or sell. I'm just walking through my process. But I don't mind getting the puts assigned to me here because it's sort of what I consider the low end of this. And, I could buy more common shares, but I don't want to use margin because I'm semi-retired now. But one of the things I have been doing, which I mentioned, and it's kind of risky because, you are committed to buy something. So the puts that I sold at $9, when this dropped to like 7 something, I'm being forced to buy puts. I'm being forced to buy shares at $9 that I could easily buy at 7 instead. But if you sell puts on this, then if the price goes up from where it is now, it's likely that those puts can expire out of the money, and then you just keep that money. And if they don't, then you get to purchase it at a lower price than you otherwise would have. So it's trading at 847. Let's call it 850. If you look at puts, for instance, a week out, November 21st, it's November 10th today, 850. Here's the bid and the ask. So if you wanted to sell one, the person's currently offering to sell it are 80 cents, and the person's offering to buy it 50 cents. So even if you didn't get a fill between these two, even if you said, you know what, I would just like to sell a put and 50 cents is fine. Each put that you sell, 50 cents times 100 shares, that's $50. So instead of buying 100 shares for $850, you would get $850 minus this $50 premium. So your effective price is $8. So the price is $850 now, almost. And if I were to buy 100 shares, it would cost me $850. But if I sold a put, and a week from now, they made me buy it at $850, I got $50 for that. So instead of paying $850 like everyone else, I'm effectively paying $8. So that lowers your cost. And if it goes up from here past $850, and a week from now, it's like $851, $858, $9, whatever, you get to keep that. So that's each one you sell would be $50 times however many of those you sell. But again, that is a riskier strategy, and I would do it if it's a stock that I don't mind owning. And if you don't know enough about natural gas to make that decision, then you should look at stocks that you do know enough about. So I've done the same thing with Crocs, and Crocs are very easy to understand, and I own Crocs, so it's a lot easier to understand than liquefied natural gas. But anyway, that's my thoughts on that for today. So have a great day, everyone. Like and subscribe so you'll see future updates. And if you have questions on this or you want to see other videos on other things, leave them below and let me know what your opinions are on Venture Global or any other stocks that I've mentioned. Have a great day, everyone.